Hi, this is Terry. Let's do our next chapter, Chapter 6. In our previous chapter, what we worked with was periodic versus perpetual inventory, and we looked at the cost of goods sold section, which is a major concept. What we're doing in this chapter is looking how to set the dollar value for inventory. And before we get into the different FIFO and LIFO, etc., there's a little bit of terminology that we want to use. And one of them is inventory turnover. And the idea here is if we take our cost of goods sold and divide it by the average inventory is just simply January 1st balance plus the December 31st divided by 2. Then what we're looking at is how many times do we turn our inventory in a year. The faster we turn the inventory, then obviously the greater the sales. So by keeping track of our inventory and keeping track of this number, it's an indication of how well the company's doing. The second one then simply takes 365 divided by the number of turnovers in a year, and that will tell you then how many days. So if you came up with something like 45 days, for Sears, who sells durable goods, that would be outstanding for them to move the refrigerator. You know, the average refrigerator is sold within 45 days. Items that you would buy at Walmart that are consumable goods, then 45 days or perishable goods, that would be crazy. That's number's just too high. The next concept is just-in-time. That's typically a whole lecture unto itself. Just-in-time inventory was developed by the Japanese. It was around, somewhere in the 70s. And it's how they managed to survive when American businesses were in extreme trouble when the interest rates went sky high. And the issue here, just kind of boiling it down to one major concept, is what you want to do in just-in-time is just not have any inventory. So you don't have raw materials inventory, you don't have inventory sitting in the factory partially made, and you definitely don't have inventory sitting out in the finished goods warehouse. You make the product once you have the order for the product. So again, it's a very complicated, involved topic, but you'll see it if you take a managerial accounting course, and especially when you get involved with cost accounting. The next concept that we want to look at, and I'm going to shake this just to get rid of my red marks here, is that with our inventory systems, we're concerned about the flow of goods and the flow of costs. When we do the specific ID method, then we're keeping track of every item in our inventory, where it is, and which one we sold. But for most of our inventory items, that would be crazy to keep track of each item, where it is, and which ones we sold. I mean, stop and think of something small like a candy bar. Keeping track of which candy bar was sold and which candy bar was not sold would just be too cumbersome. So at that point, what we do is we look at a flow of costs. So we have our beginning inventory because it's last period's ending inventory. Then we have all of our purchases. So we have our beginning inventory, we have all of our purchases, and if we have 10 purchases during that period, then we're going to keep track of purchase 1, purchase 2, purchase 3, and the costs associated with that. Then we have that gives us goods available for sale, which is all the items that we could possibly sell. What we're interested in doing in this chapter is then we're going to subtract out that ending inventory to give us the cost of goods sold, and that becomes the question is what dollar value do we set for that ending inventory, and that's where this flow of goods and flow of costs comes into play. There is an effect of understating or overstating this inventory. If you stop and look at our calculation here, if we would subtract too high of an inventory, if we overstated our inventory, then by overstating our inventory, then our cost of goods sold is going to be smaller. the cost of goods sold is our expense, so the lower the expense, the higher the net income. Once we get all the way down to the bottom of our income statement, our net income would be higher. If we reverse this and we understated our ending inventory, our cost of goods sold, then our expense is going to be higher. Excuse me, is going to be higher, and the higher our expense, then the lower our net income. So now we get to the big deal here, and that is looking at the valuation methods. The first one, lower cost of market, is all based on the concept of conservatism. So we would take all our products A, B, C that we have, and we see what our cost was and then what the market is. So if this was $10 and the market is now $15, if this is $20 and the market's $18, if this is $10 and this is $11, we simply go through each of our items and say, okay, when we're going to set the dollar value of our ending inventory for this calculation, remember beginning inventory plus purchases, goods available for sale, minus ending inventory is cost of goods sold. So when we're setting this ending inventory, we would take the number of units times 10 for A, we would take the number of units times 18 for B, and then the number of units times $10 each for C. So you literally look at what the cost is, what the market replacement is, and based on the concept of conservatism, you would multiply it out according to how I just demonstrated. The specific ID is the fact that you do keep track of each item that you sell. So if you're loading up, let me clear my little screen off here. If you're loading up into a room and you put the first purchase there, the second purchase there, the third purchase, the fourth purchase, and then you sell all of these and half of those, you know which purchase it is and what you paid for that group of items, and so you send that dollar value to the cost of goods sold. Then ending inventory then would be calculated with the remaining units. What we want to do is average cost, FIFO, and LIFO next, but I have some cute little images here to demonstrate the concept of FIFO and of LIFO, so I'd like to jump to them real quick. With the FIFO method, the idea is you would put cans in at the top, and then it rolls in and around, you know, back and forth, and then you pull out the cans here at the bottom. So obviously, because of how you load this soup can dispenser, the first ones in are going to be the first ones out, which is the concept of FIFO. The second two are LIFO concepts. This is called a plate lowerator. Oops, the plate lowerator, and it's what you use in restaurants. They're typically encased in metal and then heated. So you take plates and you pop them in, and they go down, and then you pop some more plates in, and then now you've got two layers, with the first ones being on the bottom, the second one's on top. And then you load the third one, so the plates go down further. So the first, the second, and the third set of plates. But when you take them out, then the third one comes first, then the second, and then obviously the first. So what this method is demonstrating is last in are the first ones out. So the last ones you drop into that cylinder are going to be the first ones that you pull back out. Same concept would be here. If you're piling items on top of one another, the last item on the pile is going to be the first one that you take off. All right, so let's get to some numbers here, which we can use this inventory data. When we're under a periodic system like we learned in the last chapter, then we're not concerned about the sale. We're concerned that we sold 280, but the timing of the sale isn't going to matter because we're going to look at all of this data. It's periodic, not perpetual. So we've got 80 units at $10, and then we purchased 220 units at $12.50, and then we purchased 200 more units at $14. So we have 500 units that we physically have on hand. Well, if you go back to our original diagram, this 80 is the beginning inventory, and then our purchases, we've got 2 purchases, and that's going to give us goods available for sale. So we have 500 units in our goods available for sale. If we subtract out our ending inventory to get the cost of goods sold, well, we know we sold 280, therefore that ending inventory must be 220 units. If we have 500, we subtract 220 units, we get 280. So the issue with or the calculation for the weighted average is that we would just total up this dollar amount, and let me clean up the screen here. So we total up this dollar amount, and what do we get here? 50 and 3/8 is 24, 1 less, so 23 and 2, so 63.50 if I did my math right. And we've got 500 units. So if we divide this by 500, then that's going to give us the average cost per unit. Then we simply say, okay, we have 220 units in inventory times this average cost. That's going to be our ending inventory. We sold 280. So we sold 280 times that average cost, then that's going to be our cost of goods sold. This method is used when you have a very roller coaster effect in your prices, and it's going to even it out because of the fact that you're doing an average. So you simply, in the numerator, take all the extensions and put that in the numerator. Then the denominator is going to be the total number of units that you either had in beginning inventory or purchased. You come up with an average cost. When we do the FIFO method means first in, first out. Well, we know that we sold, and let me cross out this 280 so it stays out of the way here. We know that we sold 280 units. So first in, first out means those 80 are gone. They go to the cost of goods sold. And this 220 goes to the cost of goods sold. So that gives us, 300? And nope, we have to back that off because we sold 280. So only 200 of the 220. So 200 of the at $12.50 and 80 at $10 goes to the cost of goods sold. What that means is this other 20 units at $12.50 and then the 200 units at $14 then becomes our ending inventory. When we do the LIFO method, this reverses. So under the LIFO method, last in, first out, then 200 of these units go to the cost of goods sold, and 80 of these units. So 80 of those units go to the cost of goods sold. So the difference here, which is what? 180? Am I doing my math right? 220 minus 80, I'm getting myself in a little bind here, right? 140. So the 140 plus those 80 units there then end up being in the ending inventory. So again, under the LIFO method, the lower ones go to the cost of goods sold, the beginning ones end up in ending inventory. Okay, the next concept then is, well, what do we do if we're under a perpetual method? Well, under a perpetual method, now this sale becomes important. So we typically make a little card, and I'll write down below here that we have 80 units at $10. So we're $10, so we're sitting at 800. And then we have a purchase, so we purchase 220 more at $12.50. So that's going to be $27.50. Now when we sell 280. So now if we're under the FIFO method, these 80 are gone, right? If we're selling 280, those 80 are gone, and then 200 of these are gone, so what's left is 20 at $12.50. Then we make another purchase of 200 at $14. And now, if we sold any items, again, we'd take the FIFO method and we'd start and cross out the beginning ones. So you have to run each layer based on when a sale occurs, and that's because you're under a perpetual system. In a periodic system, we just were concerned that we sold 280 in total. Under a perpetual system, we have to take each event and record how much is sitting in ending inventory at all times, how much is going to cost of goods sold at all times. There's two more methods here, retail and gross profit method. These methods are not usable for year-end reporting because they're just guesses. You have to use the FIFO, LIFO, weighted average, specific ID, lower cost to market. Those 5 methods all work for end-of-year reporting. But the Financial Accounting Standards Board says the retail and the gross profit method, because they are estimates, cannot be used. Therefore, they're good for interim reporting. So retail would be such as like a dress shop. Oh, we got a little bit of movement here. So we got a dress shop. So if we take our beginning inventory at what it costs us, and then this would be the dollar value of all the dresses added up. So if you looked at all the tags out on the floor and added them up, that would be the dollar amount. You get those numbers because they're last period's ending. So last period ending becomes this period's beginning. Now we know all of our purchases because we can look at the invoices and we know how much we mark up all those dresses. Then we add in our freight and we see that beginning inventory here plus all of our purchase by definition gives us goods available for sale. We have that goods available for sale at our cost of $150, and at retail that's $200,000. So we can set up a proportion of $150 over $200,000 is 75%. Well, if goods available for sale at the markup is $200,000, and we look at our cash register receipts and see that we sold $160, then by definition what's left over is $40,000. The problem is that $40,000 is at the markup value, and for us to do our income statement, we need to know what the cost is. So we can simply take 75% of that $40,000 to give us the $30,000, and we now know our ending inventory. So if we get rid of our little red marks here and look at this once again, the beginning inventory was 40. We know what our purchases are. It gives us goods available for sale. And through this retail method, then we backed into that ending inventory. Therefore, we can calculate the cost of goods sold. The gross margin method is good for companies whose gross margin or gross profit is steady period after period after period. So a place like McDonald's, their food cost is going to be 30% or 28%, whatever it is, month after month after month. So a company that turns around and says, okay, our beginning inventory is $50,000, we have purchases, so we now know our goods available for sale. If we could back into this ending inventory, we'd know the cost of goods sold. Well, if we know the cost of goods sold, we can back into this ending inventory. That's what I meant to say. So now we sit here with the gross profit method and say, well, if our sales are $400,000 and we know sales minus the cost of goods sold is gross margin. If this is sitting at 100%, and we know that our gross margin is going to be, if this is 400,000 and this is 120, then we know that, based on our percentages, that the difference here, that our cost of goods sold must be 280. Let me stop for just a second here. All right, sorry for the interruption here. Let's get back to this. If we know our sales is 100% and we know that our gross margin is 30% constantly, time after time, then 30% of the 400,000 is 120. Therefore, by definition, if our sales are 400,000, our gross margin is 120, 280 must be our cost of goods sold. So if we go back up here and know goods available for sale is 340, and we would subtract our ending inventory to get our cost of goods sold, then the 340,000 minus the ending inventory, which is our unknown, is 280,000. We now have one equation, one unknown. We can back into the $60,000 figure. So again, this is all based on the concept. Let me rewrite it here, that we have beginning inventory plus our purchases is goods available for sale minus ending inventory is cost of goods sold. So we've got the 50,000 here. We got the 290,000. So we have a 340,000 goods available for sale. We're doing sales minus cost of goods sold is gross margin. We discovered what that number is. We popped it in down below, and therefore we can back into that ending inventory. All right, so hopefully that's a little clearer the second time. A little rough the first one, I understand. All right, again, I always want to point out to you that your review problem at the end of the chapter has a lot of good information, so please take a look at it. And that's good for Chapter 6.